Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Resources Connection stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 542 million market cap. They're trading at $16 a share and they have 34 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is pretty consistent from 2020 to 2022, around 50 million. Then it nearly doubled to 93 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that more than doubles from 28 million in 2020 to 63 million in the trailing 12 months. Revenue is a sales for the company, and that went down a little from 2020 to 2021, then jumped up nicely to over 800 million in 2022. It's still at that level in the trailing 12 months, a little over 800 million. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 770 million. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $713 million. We divide that by 34 million shares. And we get a calculated stock price of $21. They're trading at $16, so they're trading at a 24% discount. It's a buy according to the model. There are only 14 companies in the same industry as RGP, and if RGP has a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx. I don't think they need to, only 2 million. Verisk Analytics spends 2.2 billion. That's a lot of CapEx spend. They're debt-free, so they have a 0 debt-to-equity ratio. Verix is 45, they're extremely leveraged. This is interesting. RGP pays the highest dividend by far of all the companies, 3.6%. They generate more free cash flow than the median, lower than the average. They rank 12th in market cap, a lot smaller than the median average. Really good price multiples, a 1.3 price to book. That's stock price over book value per share. 8.6 PE, that's stock price over earnings per share. 5.8 price to free cash flow, that's stock price over free cash flow per share. And a 0.7 price to sales, that's stock price over sales per share or revenue per share. They generate 800 million of revenue, which is lower than the median average, but really high relative to their market cap. And their 5-year annual revenue growth rate is 5%, lower than the median average. The reason I picked this company is because I did a screener in E-Trade of all small microcap stocks. I excluded some sectors and I filtered out all PEs below 10, price to sales below 2, price to book below 1.5, and debt over capital below 10%. And 5 companies showed up. Resources is one of the 5. I already did videos on the first 3. I'll be doing now next. Let's look at their latest 10Q. This is as of 2/25/2023. Their revenue for the 3 months ending 2/25/2023 is 187 million. That is down from last year of 205 million. But their trailing 9-month revenue is up. It's 591 million compared to 588 million. Let's get a breakdown of the 187 million so we know what it is. Of the 187 million of revenue, 164 million is in North America, which is 88% of their revenue. 10 million in Europe, 5.5%. 12.8 million in Asia Pacific, that's 7% of their revenue. Revenue is down in every location compared to 2022. It's down the least in Asia Pacific. It went from 13.2 million to 12.8 million. But revenue is down 10 million in North America and down 7.5 million in Europe. All the expenses directly related to generating the revenue are 115 million. Gross profit is revenue minus cost of revenue, 72 million. So their gross margins are 38%. Last year, their gross margins were 37.5%. Even though their gross profit went down, their gross margin went up because their expenses went down at a faster rate than their revenue went down. Then you have SG&A, 59 million. That's 32% of their revenue. That is up from last year of 57 million or 28% of their revenue. They had a $3 million goodwill impairment. Goodwill impairment is when you write down the value of your goodwill on your balance sheet and pass through the loss onto your income statement. Goodwill is tested annually for impairments. Before 2004, goodwill was amortized. They passed through a $3 million goodwill impairment on Citric. This is a company they acquired in the past. Right here, they say as a result of the impairment test, the company concluded the carrying value of Citric exceeded its fair value, which resulted in an impairment of $3 million. And if you want to get a little more info on why they impaired Citric, they do say despite signing numerous new clients over the past 2 years, restricted travel during the pandemic and forced court shutdowns and delayed legal proceedings both during and in the aftermath of the pandemic adversely impacted Citric's business. Then we have amortization expense of $1.3 million, which is 0.7% of their revenue, depreciation of $885,000. So their income from operations is down a lot. It was $17.5 million, 8.6% of their revenue. Now it's $7.1 million, 3.8% of their revenue. Their interest expense is down from $307 million to $147 million. Net income of $7 million compared to $19 million. So their net margins are 3.8%, down a lot from 9.5%. For the trailing 9 months, it's not as bad. $43 million of net income, 7.2% margin, compared to $46.6 million in 2022, 7.9% margin. Their earnings per share are 21 cents, down from 59 cents. And it looks like they're adding shares. Last year, they had 32.7 million shares outstanding. Now they have 33.5 million. And they pay the same dividend, 14 cents per share last year, 14 cents this year. That's for the quarter. So if you own a share in this quarter, you got 14 cents. If you own 10 shares, you got $1.40. Let's take a look at their balance sheet. Current assets of $262 million, current liabilities of $102 million. So their current ratio is a 2.6. They can easily cover their current liabilities with their current assets. They have a good amount of cash on their balance sheet, over $100 million of cash. And that is a lot of cash relative to their market cap of $550 million. They have lots of receivables, $143 million. So this $143 million should result in cash sometime within the next 12 months. $7 million of prepaid expenses. This is when you make an advance payment for a product or service you're going to receive in the future. $8 million of income tax receivables. So this $8 million is cash the government owes the company. They have lots of goodwill, $206 million. Goodwill is the premium you pay when you acquire another company. So this implies they do lots of acquisitions. We saw earlier they did a $3 million goodwill impairment. That's why their goodwill was higher last year, $209.8 million. Intangible assets of $12 million. Here's a breakdown of the $12 million. $8.9 million of customer contracts, $3.4 million of computer software. And they give the estimated useful life of the asset. They show the original gross value minus the amortized amount is what they show on the balance sheet. Last year on the balance sheet, they had $3 million of trade names, but that was fully amortized, so it's not there anymore. Backlog of $1.2 million, which is fully amortized, so it's not on the balance sheet as of 2023. They also show the amortization in years. So of the $12.3 million, $1.3 million will be amortized for the remainder of the year, $5 million next year, $3.5 million in 2025, then $2.2 million. So by the end of 2027, there should be no intangible assets on their balance sheet, unless of course they acquire more intangible assets. PP&E, $16 million. The value of the assets they lease is $16.5 million. Deferred tax assets. This should help reduce the amount of taxes they pay in the future. That's $10 million. Other of $8.1 million. Total assets, $500 million. $16 million of accounts payable. This is how much money they owe other companies for buying products or services. They owe their employees $67 million in salaries. They owe $7.7 million on their operating leases and other of $11 million. Then on the non-current assets, $11.5 million of operating leases. Deferred tax liabilities, $8.7 million. This will increase their taxes in the future, and $3.2 million of other. So total liabilities, $125 million. Last year was $209 million. Last year they had $54 million of long-term debt. Now they're debt-free. Let's look at the equity section. They raised $374 million from selling stock. They profited $81 million from running their business. Retained earnings is a sum of all their prior net incomes minus the sum of the dividends they paid out. And they bought back $30 million of their own stock. So their equity is $406 million. Let's look at the statement of cash flows. The first section is operating cash flow. And this is for the 9 months ending 2/25/2023. And the way you calculate operating cash flow, you start with your net income of $43 million. Then you add back the non-cash items on the income statement. We add back depreciation and amortization, stock-based compensation. We have to add back that goodwill impairment because that's a non-cash item. And then we have to adjust for changes in working capital. They had a cash inflow of $27 million from income taxes, and they had a cash outflow of $19 million from salaries. You can see it offsets last year's number. Last year they had a cash inflow of $19 million. This year a cash outflow of $19 million. So it's a wash. In the trailing 9 months, they generated $64 million of cash flow. Last year they generated $23 million. In their investing section, they sold Task Force, and they received $3 million. And they mention it right here. On May 31st, 2022, the company divested Task Force. That's a German professional services firm. The cash from business acquisitions and business divestments are part of investing cash flow. Also, when companies buy or sell PP&E, that's an investing cash flow. They spent $1.4 million in PP&E. So in their investing section, they had a cash inflow of $1.5 million. In their financing section, they paid back $69 million on a credit facility. They bought back $10.5 million of common stock and paid out $14 million of dividends, so that a cash outflow of $64 million. Let's take a look at RGP on Simply Wall Street, trading at $16, 537 million market cap. It's down 23% in the past year. Let's learn a little more about the company. Resources Connection provides consulting services to business customers under the Resources Global Professionals name in North America, Europe, and APAC. The company offers services in the areas of transactions, including integration and divestitures, bankruptcy and restructuring, going public readiness and support, financial process optimization, system implementation, and regulations such as accounting regulations, internal audit and compliance, data privacy and security, healthcare compliance, and regulatory compliance. They also provide transformation services, digital transformation, supply chain management, cloud migration, and data design and analytics. They have a strategic alliance with Qatar International to accelerate joint business development initiatives. They were formerly known as RC Transaction Corp. And changed its name to Resources Connection in August 2000. They were founded in 1996 and headquartered in Irvine, California. One risk they list is earnings are forecast to decline by an average of 9% per year for the next 3 years. It looks like they started trading in 2001, about $9 a share. Then a year later, it reached its lowest point, $6.12. Then it had a really nice run up over 5 years. It peaked at $34.53 in July 2007. It has not even come close to that price ever again. It dropped below $9 in September 2011, then ran up to $17 by January 2017, and then fell below $10 in March 2020. It did run up to $22 in August 2022, but down about 30% or so since that peak. Here are some news and updates. On May 26, the CEO, president, and director exercised options to buy $545,000 worth of stock. That's a bullish sign. A month before that, one of the co-founders and a chairman sold $320,000 of stock. Third quarter 2023 EPS and revenue exceed analyst expectations. This article was from April 6th. Revenue exceeded estimates by 1.6%. EPS surpassed by 11%. Revenue is forecasted to stay flat during the next 3 years. My model has flat revenue over the next 3 years. Even with that, the stock still seems undervalued. In the past 3 years, the stock is doing really well, up 43%. Its industry is up 30%, and the market 33%. But in the past 5 years and the past year, the stock is down. It's down 7% in the past 5 years, but they do pay a dividend, so they're up overall. Here's their PE since 2018. It was 22. It peaked at 69 in 2021. It's currently really low at 8.5. Their price of sales is pretty steady, 0.7 in 2018, 0.7 currently. Price to book was 1.9 in 2018, now it's 1.3. Simply Wall Street's valuation is $9. They say the stock is 78% overvalued. 3 analysts priced this stock at $18.67. They say it's 17% undervalued. Their trailing 12-month revenue is $808 million. And the forecast is for the revenue to be under $800 million by 2025. In 2012, their trailing 12-month revenue was $571 million. And then it was fairly steady, growing a little bit to 590 million by 2017. Then it had a nice pop over the next year to 730 million by 2019. It regressed a little to 629 million by 2021. Now it's at its highest point ever, over 800 million. And you can see they always generate positive operating cash flow, and they're currently at their peak. That's why they pay a nice dividend. They were debt-free in 2013, 14, and 15. They added a little debt at the end of 2016. Their debt peaked at 88 million by August 2020, but now they're back to debt-free. And their equity is higher than ever at 407 million. So pretty solid capital structure. You know how that saying goes, you can't go bankrupt if you have no debt. Their dividend yield is double the industry average. The industry average is 1.7%. They're at 3.5%. They pay out 30% of their earnings in dividends. Their earnings are $1.88. The dividends per share are 56 cents. You can see for 6 or 7 straight years, they raised their dividend up to 56 cents a share in 2019. And it's currently at that level now at 56 cents. But the forecast is for them to cut their dividend at 12 cents by 2025. I wonder why they have such a drastic cut. Let me know in the comments if you know why. The CEO's salary is $700,000, total compensation $4.6 million. She has been with the company as CEO 6.6 years. In the past 12 months, there's been 1 insider buy for 2,000 shares, 2 insider sells by the same person. 88% of the company is held by institutions, 7% by the general public, and 5% by insiders. The investment giant BlackRock is the biggest shareholder at 16%. The founder of the company and chairman, Donald Murray, owns 3.25%. My dream is one day I want to just show up on a top investor of any company, just so I could say, look at me, I'm on this list. They were employing 2,900 people back in 2013. It peaked at 3,300 in 2017, but it looks like they've done a bunch of divestments and they're down to 924. The ticker trades in 2 places, the Nasdaq and Deutsche Börse. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.